I'm Pedro da Costa, and this is Peterson Perspectives. I'm joined by David Stockton. He's Senior Fellow here at the Institute and a former Chief Economist at the Fed. And I'm hoping he's going to help me decipher the outlook for the U.S. economy as President Obama prepares to hand the reins over to President-elect Trump. Now, the U.S. economy has been fairly steady recently. The data has pointed to fairly steady GDP growth of around 2%. Payroll employment has been steady. It's hard to see this as a vote that was a rejection of the Obama economy. How do you think we are going into 2017?
So I think the economy that President Obama is handing over to President-elect Trump is just about as good as the economy has been since any time before the financial crisis. And maybe even a little better in the sense that we don't really see the imbalances that were building before the financial crisis in the current economy. So it is sustained growth, as you noted, of 2% over recent years. And in fact, I think that's probably how we're heading into 2017 with a similar pace. More recently, if anything, growth's been a little better. But it's fundamentally a reasonably balanced, healthy economy that is nearing full employment. We don't know exactly where that is, but we're probably pretty close at this point.
Yeah, well, the unemployment rate was 4.6% at the latest brush. And so one of the reasons that I guess people didn't feel that this recovery was really a recovery or that they were benefiting from it is the lack of wage growth that's really been persistent, really even from before the Great Recession. How is that looking, and how do you think policymakers at the Fed are going to look at that trend and how it might inform their thinking?
So in fact, I think we're seeing some signs that wages over the past year have firmed, but not a lot. And we sort of moved up from the 2% range that we've been running in for a number of years. We're probably running at around 2.5% right now. Unfortunately, I mean, one of the reasons I think why people have felt this recovery has been disappointing is that the growth and productivity to support those wage increases has been weak as well. So there isn't a lot of upside potential at this point. And I think the Fed is going to be encouraged in the following sense, that they were worried that inflation just a year ago or so was running 1.25%. We're sort of running 1.75% and appear to be headed back to their 2% objective. So they're going to feel a little more confident about that. I think they're going to be looking at an economy close to full employment, growing at close to potential. I think all of that sets them up for raising interest rates in December for the second time in a year.
Really gradual pace.
Really gradual pace.
Yeah, so given that December rate hike is sort of baked into the cake now, what kind of economic policy do you expect from President-elect Trump, and where does that lead the Fed? I mean, the markets had initially been focusing on the potential for fiscal stimulus and for deregulation. What can we expect?
So in fact, I think we'll get those things. I think they will take longer and the process will be a little bit uglier than seems to be the market's current expectation. I think 2017 will be a year in which there will be a lot of negotiation. It will look like something's going to pass, then it will look like it's going to fail, then it will look like it passed. In the end, I think they will pass. Tax cuts and some increase in infrastructure spending, not of the scale that President-elect Trump has proposed, and I don't think even of the scale that Representative Ryan has suggested. There will be enough pushback from the remaining moderate Republicans and deficit hawks that remain on the Republican side to prevent quite as big a blowout on the deficit side as the Trump or Ryan plans would likely produce.
Okay, and so does that leave Fed policy in a sort of pleasantly boring place where they can afford to wait and see and actually raise rates as a gradual pace if the economy remains
So
steady?
I think over the longer term, or the medium term, we're looking probably at a faster pace of rates because we are going to have more fiscal stimulus in an economy that is already approaching full employment with inflation pushing up some. But for 2017, in fact, I don't think we're going to see a significantly different contour to Fed policy than we were previously expecting. The Fed is not going to raise rates in anticipation of fiscal policy that has not yet been enacted. And even when it's enacted, there's going to be some question about what effect that policy is going to have on the economy. The tax plans that are currently being considered, or most likely to be considered, are ones that are tilted heavily towards delivering tax cuts to very wealthy individuals. Those individuals have relatively small marginal propensities to consume, so the spending impetus coming about from those tax cuts could be relatively limited. So I think the Fed is going to be, like you say, in a comfortable position, wait and see. I think they're going to follow the data. If the data continue to look strong. If the unemployment rate continues to drop, the inflation rate continues to rise, we might see faster pace than the 2 increases that the Fed is currently anticipating. But I don't think it's going to be a dramatic or immediate change in the contour of monetary policy.
Okay, and then finally, as far as the uncertainty factor, here you have a president-elect. Normally you have presidents who studiously avoid making market-moving comments in any way, shape, or form. And now you have a president-elect who's very willing to go there, whether it's on trade policy or whether it's on China-Taiwan policy. How does that affect financial markets and planning for the future and the kind of the business backdrop?
So far, until the last couple of days, I think it is affected in the following way. It's made businesses and market participants more optimistic about the outcome. They're looking at that possibility of significant tax cuts, corporate tax cuts, and significant moves towards less regulation. In the last couple of days, we've seen what could be the beginning of the downside and a greater uncertainty and maybe a shift to some pessimism, certainly in some sectors of the economy. As President Trump has indicated, he is going to be more serious about the possibility of imposing trade restrictions and tariffs that could do some serious damage, as our colleague Mark Noland here at the Institute with a few other colleagues showed earlier this fall. The potential for significant trade war would really have very devastating consequences for the U.S. economy. We simply don't know where President-elect Trump is going to come out when he actually starts making policy. How much of this is just threat, but how much of it could in fact be, put into action. And at least for a time in some sectors, that uncertainty could very well weigh on investment activity and hiring.
Okay, Dave Stockton, thank you so much.
Thank you, Pedro.